Springleaf, better known for its roti prata than a residential enclave. Ulu, no school, highway noise, there you have it. All the reasons why Springleaf just doesn't seem to make any sense at all. But Singaporeans just like to be beside the MRT. And this is perhaps going to be one of the most value for money ones we're going to see in a while. So, what should buyers do? So to help everyone out, I spent the last week researching and analysing the data for Springleaf and by extension, Lentor using our exit strategy framework. And the results might surprise you. The biggest concern about Lentor and by extension Springleaf is the large supply of units coming online in a short period of time to the tune of almost 5,000 units. And the question on everyone's mind is how would that impact profits? So to answer that question, we've done our research by analysing the price performances of all the condominiums within vicinity of all 137 operational MRT stations in Singapore. And we have summarised that result into our oversupply video, and you can catch that by clicking somewhere on this video or down in the description. So to save you the effort of clicking out of this video and clicking back in, I'm going to give you a quick summary. Here's a look at the sheet. If you want to take a look at it, feel free to reach out to us. We'll be happy to send it over to you. But a conclusion is that there's no real correlation between the supply in an area and the profitability of the condos in the vicinity. More importantly is to understand the supply and demand dynamics of that area. Speaking about supply, out of the 3,000 units launched in Lentor, we are only left with less than 80 units available for sale right now. In terms of percentage, that stands at about 2.5%. Now, you might be curious, who are these people buying into the Lentor area and why are they doing so despite all the concerns of oversupply and its location? Let's take a look. So what we have done was to consolidate the buyer's profile based on where they are currently living at. Right? So when they buy a particular unit, they have to register their addresses, and from there, we could figure out where are they currently living at, right? So as you can see, this is for the buyers over at Lentor Mansion. You could see the bulk of them came from District 19, the rest of them came from District 20. So District 19 is your Sengkang, Punggol, all the way down to Hougang, Serangoon area. For Lentor Modern, a huge chunk also from District 19, also a big chunk from District 20. Lentoria, again, District 19 leads. Same thing for Lentor Hills Residences, a good chunk from District 19, also from District 20 and 27. Hillock Green, the most of them from District 19. So to put that information in a clearer manner, let me present it also via a map. So the Lentor and Springleaf area is located in District 26. So as we have seen, a large chunk of the buyer are coming in from District 19. The second highest group comes in from District 20, which is your Ang Mo Kio and Bishan area. The third biggest group is moving southwards from District 27. So now, why is everybody coming in to buy into District 26, where Springleaf and Lentor is located at, when there seems to be nothing over there? Is it because of transformation? Not really, because you're not going to beat Sengkang Punggol in terms of transformation with the Punggol Digital District. You're not going to beat Woodlands with its RTS and Woodlands Regional Hub transformation. So now what is the reason? So I guess the best way for me to explain that is through a story, a personal story from a client of ours. Okay, so for that, let's take a look at the map. Right, so we have a client that was upgrading from Punggol. They were living in the Sumang area, right? So as part of the upgrading, they wanted a upgrade in location. And their very first brief to us was that, okay, I want to be near to the MRT and I want to go further up from Punggol, because if you're already in Punggol, you're not going to go further up lah, right? Okay, so we started our search down. They wanted to start first from Hougang, and if you kind of look at Hougang, near the MRT station, there's not a lot of options in terms of condominiums, right? It's primarily taken up by HDBs. Perhaps the nearest one to Hougang MRT, you have to go a bit far out to the Upper Serangoon side, right? With our Kingsford Water Bay, with our Riverfront Residences. Else you have to go to further up over here for Florence residences, all of which you won't consider them to be near the MRT station, right? And on that note, right, I believe the new integrated development over at Hougang MRT is very, very exciting, and I think it will sell super duper well. Okay, now then if you want to come further down, right, to Kovan, at Kovan MRT, yes, there's quite a bit of condos. We have Kovan Residences, Kovan Melody, Stars of Kovan, and Kovan Regency over here, right? But if you really want to be close to the MRT, you are looking at Residences and Melody, which is a little bit older in age. Not just that, their units are much larger, so the entry quantum is also quite a fair bit higher. Okay, so alternatives really would be Kovan Regency, which I highly recommend if you are a District 19 upgrader, good value for money. Stars of Kovan is a good option as well, just that it's a little bit noisy because of all the roads surrounding it. Okay, so we couldn't find anything in the Kovan area as well that my upgraders really liked. Okay, so then we come down to Serangoon. Right, around Serangoon MRT, if you want something a bit younger, I mean, you have over here Sunglade lah, but there's usually not much supply over there. But if you want something newer, you're only looking at Forest Woods. Okay, there's the Minton that we really like. Okay, but that again is a bit further from MRT already. For Forest Woods, there's not much supply over there as well, and even if supply comes up, they tend to be pretty pricey. So my clients again couldn't find anything in and around Serangoon MRT at Forest Woods. So then we travel down again over into Woodley. Okay, so now Woodley, more options also, right? We have Woodley Residences, Park Colonial, 8 at Woodley, Blossoms, Euro Park. So Blossoms at Woodley is freehold, so prices are high, right? Perhaps the best value for money you can get right now is 8 at Woodley. If you are looking at Woodley Residences, I could probably put that table up on the screen for you guys. The 3-bedders over there have hit 2,800 PSF. When they first sold, right, we didn't bring any clients over to buy because we thought that the price there was just too expensive. Okay, as a comparison with Park Colonial, right, because they were charging like the entry prices were already at 2,000 square feet. Park Colonial, they sold out very well at the start already, so actually there's no real good options available for you, even if you want to buy something new later on, right? But in the resale market, you're not going to get a lot of supply in Park Colonial. Also, we tried to find supply in Park Colonial, but there wasn't much. Right, and even when the supply comes up, you are either staring at Avon Park, staring at the road, or staring into another block. The best stacks usually are the one that overlooks the American School, but again, the asking prices are very, very aggressive, right? Your best bet perhaps is to come down into Potong Pasir, in and around the Potong Pasir area. We have quite a fair bit of supply over there lah. But then it becomes a lot more pricey already, because now we are entering into the RCR already. Then you come into Boon Keng, not much supply. 8 River Suites, people don't really like it due to its layouts and facings and whatnot, and you don't really go down any much further already lah. So then the search reverse back up. Okay, then once we come up into Woodley side, then or the Serangoon side, then you start to explore down to Bartley area. Bartley, we have Botanic, Bartley Residences, Bartley Reach, which they did explore, but again, you're looking at 3-bedders, 4-bedders, supply is not high, right? Then you come down into Lorong Chuan, very, very expensive. You either go for very old, 99, or you go to Scala. There's also almost 10 years already. We tried, couldn't get a unit, put in 1 to 2 offers, couldn't get the unit. They didn't want to go for Chuan Park, right? And because they had to wait very long, they weren't so keen about renting. So again, the option stopped at Lorong Chuan. If Lorong Chuan cannot get, all the more you don't need to go to Bishan, super expensive already. So we bounced back again along the MRT lines and came back up the MRT line, and we almost had to come back into Sengkang area to buy things like the Vales, Treasure Crest, Bell Waters, but very luckily we were able to snag a unit over at 8 at Woodley for a really reasonable price, and that's only because the seller was a friend of ours. If not, the reason why I'm sharing this story is that the upgraders, the huge number of upgraders over at District 19, they actually don't have a lot of options available, especially if you are looking into the resale market. And so, once they go on this journey, not much supply, then how? They have to shift their attentions elsewhere, right? They don't really flow into the Bishan, Tua Payoh, Ang Mo Kio area. unless they can afford it, right? They are not going to go further east. Some of them do, but not many will go further east. And if you go further east, you will start to hit areas like Tampines Avenue 10 that have done really, really well over the years, as much as we feel that it's not convenient, right? Tampines Avenue 10, we have all our condos such as over here, right? Cubase, Santorini, the Alps, Park Central Heaven, MOP, yet. So there really, end of the day, there really isn't much options available, right? And we have quite a number of clients in there, they kind of give up hope, or they kind of like, you know what? If we have to go through all this hassle, you know, we might as well just buy a new development. And then they take a look at the developments at Lentor and they realize that, you know, it's not that expensive. Layouts are decent, right? And it's close. Important thing over here is close to the MRT, okay? And so a good number of them, now we're not saying all of them end up going to buy, but a good number of them, they decide to, you know what, we're just going to go out and rent and then buy a unit over at Lentor. Now, the interesting thing about that breakdown of the buyer profiles that I shared earlier is that we see a lot from District 19, but actually there's a huge number of upgraders over here from Sengkang, from Sembawang, Woodlands, Canberra, and Yishun. Over here, this area, a huge number of HDBs have not yet hit its MOP. We're going to see a chunk of supply coming in around Lorong Chencharu area as well. Now, all this demand, they're going to follow the same trend as our District 19 demand, whereby once they hit their MOP, they want to move further south, closer to the city center. Now, look at this map of Singapore. It nicely funnels all that demand because they aren't likely going to jump over into Sengkang Punggol, kind of no point. And actually Sengkang Punggol also no supply already, so no reason for them to go and fight the supply there and pay high prices. So they're all going to come funneling down over here. And once they come over here, right, they hit your Ang Mo Kio, Bishan area. They are either very old, 99, Bishan Park, condo, that kind of thing, right? Or very expensive, you're looking at Jadescape, those sort of things. Then you're going to start exploring back up again, this very same story of the typical upgrader story that I shared earlier, right? And then you're going to start exploring the Lentor area and the Springleaf areas. Now, this is how I kind of imagine the demand flow to be like for this Lentor and Springleaf area moving forward in the future. Hopefully that gives you a little bit more clarity on the potential exit strategy if you look to buy into that area. If you've enjoyed or benefited from the video so far, we'll be really thankful if you could hit that like and subscribe button, as you'll help out the channel a ton. Now back to the video. So now that I've touched on the qualitative part of the analysis, now let's take a look at the quantitative part where we take the data and figures and put them into our exit strategy framework. For those of you joining us for the first time and you have no idea what our exit strategy framework is about, you could check out this video by clicking on the link somewhere in this video or down in the description. I know, nobody has time to click out and click back in, so here's a quick summary of why and how we created the exit strategy framework. Why? It's because exit strategy is this big word that's been thrown around a whole lot recently, and the answers that we've gotten just seem terribly generic. Things like, transformation, HDB upgraders, that kind of applies to the entire island. And the worst of all, foreigners. So if it's so generic, it doesn't help give you any clarity at all as to whether one project is better than another. Therefore, we utilize our close to 10 years of experience to extract out the important data points, allowing us to analyze this utilizing purely facts and figures and distilling that down to give us the exit score and the gap score. And now let's get right into it. So over here we have the exit strategy framework analysis for Springleaf Residences. Again, for any one of you who wish to take a look at this for yourself, feel free to reach out to us. We're happy to send it over to you. And I'm going to start off first by running through with everyone, right? What are the data points that we use and why we use them? So first of all, we have price per square feet. Okay, and I'm utilizing 2,200 PSF because we have analyzed all the land sales over in the Lentor area. Okay, and so this is the land cost. Over here, we have the HPROP estimated break-even. So HPROP has this algorithm whereby they factor in all the marketing costs, the construction costs, the potential borrowing costs as a function of the land cost, right? And they come up with the expected break-even number, right? So we are utilizing their estimated break-even number over here. And for all these developments, they've already been sold to a certain amount. We have the average sale prices of all the units that have been sold to date, okay? And from there, we are able to calculate the difference between, say, the land cost and the average sale price. And similarly, the difference between the estimated break-even price done by HPROP and the eventual average sale price, okay? And I've also put here, right, some of the whether or not the project has been GFA harmonized, is GFA harmonized or not. So we have kind of took an average, right, of all the properties that have been sold so far, right? And the average percentage as a function of land cost is 104%, right? The average difference between the HPROP break-even and the eventual sale price is 16%, right? But if we zoom into just the harmonized projects, which is Lentor Mansion and Lentor Central, that stands at 128% and 25%. Taking these percentages and the land cost and estimated break-even by HPROP for Springleaf Residences, we have a range of numbers, right? Going as low as 1,850 PSF all the way up to 2,100 PSF, right? So I'm going to be a little bit conservative and plug in 2,200 per square feet, okay? Right, so and we already have the sizes available, and then that will kind of give us the price of the units, right? Then next up, we have the average profitability per annum. This is the number and this is the data that I utilize as a proxy of demand. Why? Let's start off first with sellers, right? All sellers is going to come out hoping to make maximum profits. Yeah, and so if an area has high demand, very likely their unit will be stepped up quickly, allowing them to yield high profits. Versus an area with low demand, likely the unit will take a longer time to sell. And if all owners take a long time to sell, they will likely reduce their price to sell their units. That eats into profits, okay? So that's why the best proxy for demand really is just analyzing the average profitability per annum within an area, okay? Which are the projects that we use? I'm going to share that with you later on, right? Current unit for sale, it's, within this area, which are the current units currently for sale, right? I use this number together with the total supply of units being built in that area. And for this, we have also already included the units that are currently being built that are not completed yet, okay? So by taking a function of what is currently for sale versus the total being built, we have our supply ratio. And then when we take the supply ratio divided by the average profitability per annum, we have this percentage over here that is, telling us the supply and demand of that particular area. So with that, the lower score, the better. Okay, next up, we then take a look at the average and median and highest surrounding quantums. Okay, and at this point, I think it's good that I show you which are the developments that we have considered. So over here, we have all the new developments, right? Lentor Modern, Mansion, Central, Hills, Lentoria, similarly also Hillock Green, and we have some of the slightly older resale. We have Castle Green, Far Horizon Gardens, Meadow at Pierce, that's a little bit further away, Panorama, right? Why I chose all these developments instead of, what I traditionally do is just to take 500 meters within the area is because if I take 500 meters within Springleaf MRT, there will be no results, and then there's nothing for us to show, right? And if I take 500 meters within just Lentor, right, I don't think there's going to be a lot of data available as well because there's only a limited number of resale developments in that area. So why did I expand out to cover places like Thompson Grove, Panorama is because I feel should people come in to want to buy that area, these are the other developments that we'll potentially consider. Okay, and for that, yeah, we've taken the average of all the transactions of each particular unit type across all those condos over the last 12 months. Yeah, and We have put those numbers over here. Then we find the gap between what's our expected PSF, right, times the size, and then what's the gap between that over here, right? So if you see a negative number, it's good, meaning you are buying in at below the surrounding quantum, okay? We've utilized the same idea with PSFs, okay? So again, if you see a negative number, that's great. That means you are below the average transacted PSF in that area. Now, let me give you an example of how we utilize this exit strategy framework for our clients. So over here, we have a client with a budget of about $1.7 to $2 million, right? So for that, we have over here the 3-bedder over at Springleaf, right? So these were the scores that you see that you saw just now, and we have another 2 developments, right? These 2 developments are 2+ studies located in the RCR, right? So one is a 3-bedder in the OCR versus a 2+ study in the RCR, and I believe this is a very common consideration for a lot of the buyers in the market right now. So now, how do you utilize this to compare, right, and determine which one is best for you? So you can see over here, the RCR 2+ study is going to be much more expensive, understandably so, right? But is it justifiable to pay that? So going down these numbers, you know, as the average profitability, this development can match up to the Lentor area, okay, but this one is going to lose out by quite a fair bit, right? But one of the things I would consider, right, is the fact that the supply over here is going to be much larger than the supply over here. So even though, right, I'm going to have new developments, this new development is going to TOP and give in new supply into this area, this increase over here on the current units for sale will be nowhere close the kind of increase that we are going to see over here. Now, what does that mean? That means eventually this exit ratio score is going to come up significantly higher. Then if that's the case, if you're just analyzing it like that, then this development will be better, simply based on this one exit score, right? But does this mean you should buy this one instead? The answer is no, right? Let's take a look a little bit further. In terms of gap score, because in terms of gap score, right, the 3-bedder over at Springleaf has a much better gap score as compared to this 2+ study. Why? Because the 2+ studies compared to the other 2+ studies, the 2-bedders in the area, so the gap is a lot smaller, right? Over at Springleaf, you're comparing against the other 3-bedders in the area. But there's nuances to this as well, because the 786 square feet, you notice both are 786 square feet. So now one will be the smallest 3-bedder in the area, naturally giving you the lowest quantum in that area. But when people come in, will they have complaints about the layout? Now, this is where we have to dive in and take a look at the layouts in greater detail. But this 786 square feet is perhaps the best 2-bedder in that area, right, with excellent layouts. In the study room, you can also put in a single bed, almost functioning close to a 3-bedder like that, right? So there are nuances involved when you want to consider whether or not one is better than another, right? And how do we go about doing that for our clients, right? And how you can potentially go about doing that for yourself, right? So these are other factors to consider, okay? The more qualitative side to things, okay? Consider the size of the developments, right? So for this, Springleaf is going to be 900 units, much bigger than the 500 units over here, okay? Then we have transformation, Springleaf, maybe not so much, both of these. No, not so much in terms of transformation, but if you're talking about new plots, Springleaf, there's plot A that's already out on tender, so that's going to be sold eventually. Most likely the price will be higher because it's a mixed-use development right next to the MRT, while this other development don't have, okay? We are considering age of developments, but if you're just looking at all new developments, then that doesn't really matter. But this exit strategy framework works as well if you're also considering resale properties, and that's where then the age of developments kind of matters, okay? Next up will be rental yield. Now, this is where things get a little bit more interesting, okay? So this client is looking for pure investment, right? So now what all of us kind of hope to, you know, flip and sell in 4 years for our profits. Just in case that doesn't happen, you then got to fall back down to rental yield, right? So on this note, while the 3-bedder here has great gap score, and it's nearer to the MRT, this one is further from the MRT. I do expect potentially the rental yield for Springleaf due to its distance away from town to be lower than this one, because while this one is a little bit further from the MRT, it is located within 1 km of a really good primary school, and historically the rental yield over in the area is a lot stronger, right? So now see, there's a lot of pros and cons on either side. Now how do you really balance it out? Not that straightforward, right? And I do suggest to look even wider than just the numbers alone, okay? We use this to kind of narrow down, then once it comes down to the two, you got to use the qualitative kind of factors to determine. Right, next up, if you're own stay, of course, you're looking at schools, MRT amenities, needless to say. Now, then how do you kind of determine and what are the recommendations I might have? Let me give you some examples, right, for portfolio optimization. So in terms of holding period, okay, if you are someone who is a little bit younger, I'm talking about like early 30s or maybe even in your 20s, you could select something potentially has a higher growth potential, right? Because the gap score is good, right? You have a wider gap to the surrounding quantums, the highest achieved quantums. You have the runway to catch that. Yeah, and more importantly, right, if you are a young couple, right, you may want to buy a property that has a higher protection in terms of in case your family grows bigger, right? So on that note, I would usually recommend a 3-bedder. For them, you can buy in an area that is a little bit further out but has higher kind of growth to it, okay? Alternatively, on the flip side, if you're already in your 40s, for example, right, and you know you want to make one more good flip before you hit your 55 years old, for example, you may then lean more towards something that is a little bit more tested and proven, something more so in the ASEA, tested and proven, still with strong data points, maybe within 1 km of a good school, right? Because you somewhat cannot afford to wait it out too long, right? You want to have highest chance, go by the tested and proven route, 4 years, but flip change to your final one before you kind of hit your 55 years old, 65 years old, that you cannot take any leverage anymore. So here you can see, right, same scores, same everything, but depending on the person, the recommendation might differ. Yeah, portfolio sizing. Case in point, right? Just got off a call with a client. They were kind of looking to reevaluate their portfolio because their income have come up and then they don't feel like the current asset they are sitting on is maximizing on their new income and also maximizing on the cash that they are sitting on. So, you know, should we or should we not, right, kind of upsize the portfolio? The thing is the existing property that they are sitting on. Maybe if you are watching this, you know you know who I'm talking about, right? But the only issue is the current property they are sitting on, they like it, and the prices haven't really gone up by much, right? So then this brings me to my next point, right? It's a discussion also on opportunity cost, okay? If you want to upsize your portfolio, right, if you want to do it sooner, then we kind of got to consider maybe, you know, not making so much on your current asset. Look at the upside potential of the next asset you're going up, because you're upsizing in terms of your portfolio, 2 million to 3.5 million. The one go up by 10%, you make more. But if the same one at 2 million goes up 10%, so these are kind of opportunity cost considerations that you kind of have to look at, right? Always look on the both sides, the sell and the buy side. The problem with a lot of people is that, you know, they're overly focused on the sell side. If not willing to hit a certain price, they're not willing to let it go, but in turn, you know, lose out on some opportunities, right? They're out on the buy side. Looking at exit timing, right? When is the best time, right time to sell? Okay. Next up, right? Of course, once we narrowed down into a particular development, you got to do your competitor analysis, layout analysis, stack analysis, things like that, right? PSF within the development, for example, right? If the entry, you know, the cheapest stack, lowest floor, cheapest stack, and the highest floor, right, that staging can potentially bring you up to 400 PSF differential, right? Which one should you pick? Okay, and I'm going to flash it on the screen, kind of our scope of services for the clients that we work with to approach a launch. So if you find all of this overwhelming, don't worry, just reach out to us. We'll be happy to help you out. Or if you just want to take a look at the research that we have done, similarly happy to share it with you. Now, moving on to the 3 things we like and don't quite like about Springleaf Residences. Starting first off with the 3 things we like, and on point number 1 is the size of the developments. I'm talking about the 900 odd units. So this is going to be much larger than all the developments over at Lentor, right? The largest of which coming in at slightly over 500, slightly less than 600 units. So this is 900 units, right? Basically, in the OCR, if you have a 900 unit developments in such short distance to MRT, they traditionally have done very, very well. I'm just going to give you an example of High Park Residences that is not even anywhere close to the MRT, but 100 over units entered at a very good price during that period of time, and they have made spectacular profits. Now, this is, I think, not too different from High Park Residences, except it's closer to the MRT. Okay, so I think this number of units really gives it a nice economies of scale and its distance to the MRT. So despite all the potential downsides, I think it will do well. On to the second thing I like about Springleaf Residences, it's the views. For that, let's take a look at our friend Google Earth. Right, so here we have the plot over here, and this is likely going to be plot A, the new plot. So most of the blocks, right, are orientated this way. You can look out into the greenery here, and if you choose a little bit of a higher floor, you can get the reservoir view. But do note that there's going to be a little bit of west sun over here, like if you want to see the reservoir. Okay. Even those that view south, for example, overlooking the highway, similarly, very, very nice greenery view onto Lower Pierce Reservoir, right? So if you're somebody like likes this kind of stuff, right, this is great for you. And honestly, you don't really have any alternatives for that, right? And also, since we are on this, I think this is something that, you know, a lot of people haven't really talked about, right? It's the amount of landed properties in that area. While it's not a huge landed cluster, well, this might be some of your potential buyers in the future, because in this batch, in this couple of years, right, there's a lot of landed owners, the baby boomers, they are looking to retire, looking to right size, and you know, they are selling their landed properties and coming down to condominiums. And very naturally, right, because these people are already so used to the area, they may potentially buy units over here at Springleaf, right? If we come down as well, over Lentor, Teachers Estate, also much larger landed area. Similarly, if they sell, they are looking to buy back within the same area, because, you know, who else loves greenery exercise more than retirees, right? Additionally, I think there's no real good alternatives if somebody likes greenery and wants to buy a condo that offers them greenery anywhere around this area. Because once you see, if you look over here in the Woodlands part, it's all pretty much built up. And even if you buy the units over here, you're looking more so into the air base than, you know, the Lower Pierce view. And there's actually not much supply over here. Similarly, in Sembawang, Canberra, no real chance for you to buy something of this view. Khatib, Yishun, unless you buy over at the Miltonia area, giving you views of the Lower Pierce Reservoir, but most of the condos, HDBs over here are already in a largely built up area, so there's little to no chance of you getting anything like the views we're gonna get at Springleaf. Now, if you move southwards over at Lentor, the units over at Lentor, they won't be offering you such views as well. You know, the best you're gonna get is kind of the views of the Lentor Park, right? But nowhere close to this kind. Then once you go down to Ang Mo Kio and Bishan, again, right, needless to say. Of course, I think there are some condos over here with views of MacRitchie Reservoir, but Bishan and Ang Mo Kio, most of them, you will not offer such views, right? So despite its location, right, the ability to offer a product that is quite different from everybody else may potentially put you also in a decent position, right, where you don't have too much competition lah. On to point number 3 on what I like about Springleaf Residences, it's its entry price. So if you have seen earlier, the developers have bought the land cheap at slightly over 900 PSF PPR, and based on our calculations, they can launch as low as 1,800. Hopefully, they are not overly aggressive. If they come in at 2,200, great, right? You'll effectively be one of the cheapest launches within a short walking distance of the MRT anywhere in the market today. And if you've watched the video earlier on, right, I've also mentioned how I believe the Springleaf and Lentor area is very nicely situated to catch a lot of the upgrader demand all the way from the northeastern part of Singapore, Sengkang, Punggol, due to the lack of supply down the northeast line, and also all the demand from the HDB upgraders moving southwards from your Woodlands, Sembawang, Canberra, Yishun, Khatib, Lorong Chencharu. So many HDBs hitting their MOP, and as they all move southwards, they fall into this little funnel. There's actually very little supply coming online. So good entry price near to MRT, high upgrader demand. That's what I like about Springleaf Residences. So now onto the 3 things we don't quite like about Springleaf Residences. And on the first thing we don't quite like is the fact that there might only be one potential new development coming up in the area to help you push up your prices. So that would be Parcel A. Okay, it's because this area is kind of designated as a very green area by URA. So not a lot of land has been designated for residential use. It's basically, as of now, only these 2 plots. Of course, nobody knows if there's anyone coming up in the future, but you have to be aware that coming in, there's only Plot A and Plot B for this area. So after Plot A comes out, right, there's no real new developments in the area to help you push your prices up. On to point number 2 on what I don't quite like about Springleaf Residences is the lack of a primary school in its vicinity. Now, we know that the potential exit audience for us are HDB upgraders, and a lot of them will have kids looking to go to primary school. And if there's no primary schools in that area, what they will have to do is to either continue putting their kids in the primary schools of the areas that they're upgrading from, say Sembawang, Canberra, Yishun, even the northeast side, Sengkang, Punggol. Now, would that stop them from buying into these units? Potentially, yes. Okay, but then again, that comes back to my earlier point on the fact that there's actually no real good alternatives in those areas. Honestly, if you go and take a look at the supply of 3 and 4 bidders in the whole Sengkang Punggol, for example, right, resale ECs, you'll be surprised at how little supply there is over there, right? So with this surge in upgrader demand, there's no real good alternatives, then they are kind of have to force to make the decision. Some will say no, but all you need is a number to say yes to have a strong demand for units over at Springleaf Residences. Adding on to the previous point, we've also seen how despite the lack of a primary school for the developments over at Lentor, those that are not within 1 km of St. Nick's, they have not dampened demand for those units at all. On to point number 3 on what I don't quite like about Springleaf Residences is the highway noise. As you can see from the site plan, a good chunk of the development will experience this highway noise. So now I'm very curious actually to see how the developers will price those units, because in a way they are prime because of the view, but they are hindered by the highway noise and also potential west sun. Now this is an opportunity if you are an investor, because then you can kind of gauge, right, how the developer will stage the pricing. Should they be staging those significantly cheaper? Maybe you can buy a nice high floor unit, good layout. There are some locked in profits to be made over there, versus let's say an inward facing, should they be pricing it a lot more expensive? Yeah, I would take the bet to buy some of the outward facing ones. No issues with the highway noise, because we have tons of examples of how despite highway facings, units still yield good profits. Okay, but of course if you are looking for own stay and you don't like the highway noise, you don't like the west sun, you're not somebody that kind of needs the views, then by all means, right, you buy the inward facing ones. So here, let us know in the comments, right, do you think the developers will price the nice view but highway noise higher, or the inward facing ones higher? And with that, we've come to the end of our review. And if you've liked it, please help us to hit the like and subscribe button, as it will help out the channel a ton. If you'd like to find out more about Springleaf Residences, feel free to reach out to us. We'll send the info over to you along with all the research that we have done. We also have lots of free ebooks for you, depending if you're a seller, buyer, investor. All you need to do is click on the link down in the description to download them for free. And lastly, before we go, if you resonate with our systematic, data-driven approach to property purchases and portfolio planning and would like our help with that, feel free to reach out to us. If not, thank you so much, and I'll see you next time. Bye-bye.